Something unusual just happened. Over the past few months, nearly $180 billion worth of gold has been quietly added to central bank reserves around the world. Not announced with headlines, not debated on primetime television, just reported in dry data releases that most people never read. But when governments start moving this much money into one asset at the same time, it usually means one thing. They see something coming. This isn't retail investors buying coins online. This isn't influencers talking about inflation. This is sovereign-level capital, central banks, monetary authorities, the same institutions that control currencies and influence interest rates. And right now, they are accumulating gold at a pace we haven't seen in years. The question is simple. Why now? Before we go deeper, if you follow macro trends and you want calm, clear breakdowns without hype, make sure you like the video and subscribe to The Silent Collapse. It helps the channel grow, and it tells the algorithm that serious economic content still matters. Now let's slow this down and look at what's really happening. Gold is not just a shiny metal, it is a monetary asset. For thousands of years, it has been used as a store of value when paper systems become unstable. When trust rises, gold usually moves quietly. When trust falls, gold becomes insurance. So when central banks increase their gold reserves by billions, they are not chasing returns. They are managing risk. Here's what makes this moment different. Inflation is still above long-term targets in many developed economies. Government debt levels are at historic highs. Interest payments alone are consuming larger portions of national budgets. At the same time, geopolitical tensions are rising. Trade relationships are shifting. Sanctions are being used more aggressively. And the global financial system is becoming more fragmented. Gold sits outside that system. It is not tied to one country's political decisions. It does not depend on a central bank's promise to pay. It has no counterparty risk. When institutions accumulate gold, they are reducing exposure to currency instability and systemic shocks. Now, think about the timing. For years, central banks were net sellers of gold. They were comfortable holding dollars and euros. But recently, that trend reversed. They are now net buyers again, and not in small amounts. Nearly $180 billion worth added, quietly. If everything were stable, if confidence were strong, if the global outlook were predictable, there would be no urgency to increase gold reserves at this scale. So what are they preparing for? One possibility is currency devaluation. When governments carry massive debt, one long-term solution is allowing inflation to reduce the real value of that debt. That weakens purchasing power. Gold historically performs well during those periods because it preserves value relative to paper currencies. Another possibility is geopolitical risk. We've seen how quickly reserves can be frozen or restricted during conflicts. Countries are learning from recent events. Physical gold stored domestically cannot be frozen by foreign governments. That matters more today than it did a decade ago. There's also the issue of trust. Trust in institutions. Trust in fiscal discipline. Trust in monetary policy. Markets can function smoothly for years on confidence alone, but when confidence begins to erode, capital shifts quietly before headlines catch up. That's often how major cycles begin, slowly, under the surface. Retail investors usually react after prices move, institutions position before. Now here's where it gets more interesting. Gold does not generate yield. It does not pay dividends. In high interest rate environments, holding gold becomes less attractive because bonds offer returns. Yet despite relatively elevated rates, accumulation continues. That tells us something. This is not about short-term yield. This is about long-term security. And when multiple central banks move in the same direction at the same time, it suggests shared concerns. Let's zoom out further. Global debt now exceeds $300 trillion. Government deficits remain large. Political polarization makes fiscal reform difficult. Demographic pressures are increasing entitlement spending. And economic growth in many developed nations is slowing. That combination creates structural pressure on currencies over time. Gold becomes a hedge against that pressure. Now ask yourself this. If the institutions that design monetary policy are hedging their own system, what does that signal to everyone else? It doesn't mean collapse tomorrow. It doesn't mean panic. But it does mean risk management at the highest level is changing, and shifts at that level rarely happen without reason. History gives us examples. In the early 2000s, gold accumulation increased before major currency adjustments. After the 2008 financial crisis, gold surged as trust in banks declined. During periods of aggressive monetary expansion, gold became a refuge. Today, we are seeing record peacetime debt levels combined with rising geopolitical fragmentation. That is not a normal backdrop. At The Silent Collapse, we focus on slow structural changes, not daily market noise. And structural shifts often start with reserve allocation. Another angle to consider is diversification away from the US dollar. The dollar remains dominant in global trade and reserves, but some nations are gradually reducing exposure, not replacing it entirely, just diversifying. Gold offers a neutral alternative. It doesn't require settlement through Western banking systems. It doesn't depend on SWIFT networks. It doesn't require foreign counterparties. In a world where economic alliances are shifting, neutrality has value. Now, think about investor psychology. When headlines eventually catch up and mainstream media begins talking about record central bank gold buying, prices may already be significantly higher. Institutional accumulation often precedes narrative shifts, and narrative shifts drive retail flows. That's the sequence. Smart money positions, price stabilizes, confidence builds, media attention rises, retail follows. By the time it feels obvious, the early move is already complete. This is why understanding reserve flows matters. Some analysts argue this is simply routine rebalancing, and that's possible. Central banks regularly adjust portfolios, but the scale and consistency of recent buying suggests more than routine management. It suggests conviction. Conviction usually comes from risk assessment. Another factor rarely discussed is currency competition. Emerging economies are strengthening regional trade agreements. Bilateral settlements in local currencies are increasing. Gold acts as a common anchor when countries seek independence from a single reserve currency. It reduces reliance without creating direct confrontation. That's strategic. And strategy at the sovereign level moves slowly but deliberately. If you're still watching at this point, you already understand that this isn't about hype. It's about reading signals early. Gold doesn't spike overnight without catalysts. It builds pressure quietly, the same way central banks accumulate quietly. So where does this lead? If accumulation continues, it could tighten physical supply over time. That could support higher long-term price floors. It could also reinforce gold's role as a core reserve asset in a more fragmented financial system. On the other hand, if global stability improves dramatically, buying could slow. But right now, the data shows continued interest. The bigger question is what this says about confidence in fiat systems over the next decade. Confidence doesn't disappear all at once. It erodes gradually through persistent deficits, through policy mistakes, through geopolitical friction. Gold acts as insurance against that erosion, and insurance is rarely purchased when everything feels safe. It's purchased when risk models start flashing yellow. As we move forward, watch for 3 indicators: continued central bank purchases, accelerating geopolitical tension, and rising debt servicing costs. If those trends persist together, gold demand from institutions may remain strong. We are not predicting immediate crisis. We are observing strategic positioning. There's a difference, and often positioning tells the story before headlines do. If you found value in this breakdown, share this video with someone who follows macro trends. And let me know in the comments, do you think this gold accumulation is precaution, preparation, or something bigger? Your perspective matters here, because understanding these slow structural shifts may be one of the most important financial skills in the decade ahead. This is not about fear. It's about awareness, and sometimes the quietest moves signal the loudest future changes. Stay informed, stay rational, and keep watching the signals beneath the surface. This is the silent collapse.